Hi, welcome to the Interaxis channel, interaxis.io. So now what I really want to do is explain some of these Web3 concepts, explain some of where we're going. We're not necessarily there now, but where we're going, and do so in a way that really makes sense and make it concrete. And to do that, in this case, I'm going to talk about something that many people know about and many people have, and we're going to talk about the mortgage. And what we're going to do is break down all the different parts of a traditional mortgage and then talk about where Web3, crypto, DeFi might come in and make the process more efficient, and try not to do so in a way that makes it look like a gimmick or makes it look like we're going too far to add crypto to anything, because that's not what we're trying to do. We're trying to show where the system that's being developed, the ecosystem that's being developed, the protocols and everything are going to make things more efficient. And to do this, I apologize, this might take several videos. I refer to this as kind of my concept album, right? This is a concept album on mortgages. The irony of talking about the mortgage here is the mortgage is what led to the financial crisis of 2008, which led to the release of the Bitcoin white paper, which kind of started this whole crypto thing. So let's go back to the mortgage and see where Web3, crypto, DeFi, some of these concepts are possibly going to help us move forward and make this process more efficient. And to do that, I have to break down how a mortgage works in the traditional sense. So I apologize for doing that, but I have to break it down. I know many of you know this, but it helps. So let's say Adam, which is me, and my family are looking to purchase a home, and we finally find the home we want. Okay, so we have, we'll call it home one. We found this home we want, and we will say that this home we're going to purchase it for $500,000 US, mainly because these numbers make my math easy. So, home one, we want to purchase for $500,000. What do? I go to some sort of lending institution. We'll call it a bank, even though it doesn't have to be a bank anymore, but we'll call it a bank. And I go to the bank and I say, I would like to borrow enough money to buy this home. And the bank, of course, says, look, you may borrow up to 80% of the value of the home. So, okay, what do I need to do to borrow 80% of the value of the home from you? Because I don't want to pay cash for this home. So the bank says, all right, Adam, we need to know all about you. We need to know a bunch of information about you. We need to know, this is Adam's information, and it's Adam and family, to be honest. Adam, we need to get information about your income. And how are we going to get that? We're going to get that through 1040s, through tax returns. We are going to get it through W-2s. We are going to look at any other ways, 1099s, any other ways you're getting paid. What else are we going to get? We are going to look at your investments. We're going to look at your bank accounts. Okay, we're going to look at any other assets you might have. That might be real estate. That might be retirement plans. That might be life insurance. All sorts of other assets that you might have. And the bank is looking at all this because they want to know, am I going to be able to continue to make payments on the home? Now, we all know that this loan, this mortgage that the bank is giving me, is collateralized by the home. And so the mortgage they give me says, look, Adam, if you cannot make these payments anymore, we are going to foreclose. When we foreclose, we're going to take the home back. And when we take the home back, we're going to go try to sell it. Now, even though the bank has to get all this information, even though the loan is more than collateralized, okay, it's over collateralized. Because remember, I'm going to get a $400,000 loan, and they're going to collateralize it with a $500,000 home. So it is over collateralized. So one, the bank is going to ask me for all this information, and if anyone has gone through the process of getting a mortgage, is an insane amount of information they need. You are sending it, very often in very insecure formats, like just, I'm going to attach this to an email. I'm going to attach you my tax returns, my W-2s, and my bank statements and everything to an email, so it's not all that secure. And that someone at the bank, or many people at the bank, are going to look at everything and see if I fit the profile, see if I am going to be able, based on my income and based on my investments, am I going to be able to keep paying this loan? Why? Because even though the loan is over collateralized, the bank does not want to have to foreclose on my home, because it is a very long legal process, and the bank is not in the business of selling homes. The bank is in the business of making loans, and they want to stay in the business of making loans, not foreclosing and taking that home and going and trying to sell it. So that's not what they want to do. So one is they're going to have to get all this information from me. Okay, decide if I'm able to make the payments on the loan. Now, I forgot one other thing they're going to get, which is super important. In addition to that, in addition to all this information about me, is they're going to get my credit score and report. Okay, and of course in the U.S. this is done by 3 different agencies. They're probably going to look at 1 or 2 of them, and they're hopefully going to look at not only my score but also the report that shows how much debt I have, how well I have done paying off that debt, all of those things. So they're also going to look at my credit report. Now, the other thing the bank is going to do is say, look, we need to make sure this is a $500,000 home. So we are going to go order an appraisal of the house. And we're going to make sure it's worth $500,000, because if we're going to loan you $400,000 against a $500,000 home, we want to make sure that the home is actually worth that. So they are going to go get an appraisal. So then we go through the process, and after a while, we finally get to the point where we're closing on the home. Now, this is where ourselves and the sellers go to a title company, and we purchase title insurance. We have to purchase, pay $1,500 or so for title insurance. And what is title insurance doing? Title insurance is basically guaranteeing, not guaranteeing, title insurance is ensuring for us that the people we are buying it from, the sellers of this home, actually owned the house. They had a clear title to the house. And the people before them had clear title to the house, and the people before them. So what the title insurance company is saying is, look at them. If at some point someone comes forward and says, no, my family way back actually owned that land or owned that home, and it was given illegally or it was sold illegally, I actually have a claim on that home. So the title insurance company says, Adam, you've paid $1,500 to us for this title insurance. We've done the background check on this. But if we're wrong, we are going to make you whole. We're basically if that person or those people can come claim this home legally, we are going to make you whole, and we're going to give you basically the money for the home, the money to pay back the loan, so that you're not out a house because we made a mistake. So that's what title insurance is. And actually, things like checking title sounds suspiciously like a blockchain, right? It's one owner building on another, building on another. So it shouldn't actually be that hard. Obviously, we will get to that later. So we have to go to the title company. We have to buy title insurance here. And then once we do that, the money goes from us. The money goes from the bank plus us, because we have to put in a down payment. Correct? We put in a down payment. The bank provides the other $400,000. Hopefully we provide $100,000, and that goes to the sellers of the home, and we get the house. Well, what do we get? We get a deed to the home, which is in the U.S. recorded with the county. So the county says Adam and his family now own this home, subject to the mortgage that the bank has, such that if Adam and his family don't pay the mortgage, then the bank gets the home. And that's what goes on record with the county. Now, keep in mind, as I own this home, I also have to buy homeowners insurance. Now, the bank is going to require that I buy homeowners insurance, because this is their asset, this is their collateral. And if my house catches on fire, gets hit by a storm, a tree falls on it, any of those things, floods, and any of those things, the bank wants to make sure that the house is still worth $500,000. Because, again, if my house goes up in flames and now it's nothing but land because the house is gone and the land is only worth $200,000 and I have a $400,000 note to the bank, it's actually in my best interest to just not pay the loan anymore and have the bank foreclose on me. Right? Because all they're getting is $200,000. I would rather not pay $400,000 for a home that isn't there anymore. So the bank requires that I get homeowners insurance such that it protects the value of their investment, because this is essentially their investment. Okay? So all of this is happening just for me and my family to go to a bank or some sort of financial institution and purchase a home. This is all that is happening here. Now, we can walk through here and see what might happen in a decentralized world or in a Web3 world, and break down all those little pieces here. So if we wanted to break down where we might see crypto, where we might see something like Web3 come in, and then I'll go a little bit more in depth in these pieces in separate videos. But let's look at the idea of my providing income. Okay, or my providing all of this information to the bank. So one, if I'm providing all this financial information, this is a lot of sensitive data. I might not want it going to the bank. I might not want it going to several parties. I don't know what the security of the bank like. I certainly don't know what the security of the email system I'm using to send this information is like. So in the future, what we might see is I connect my wallet to the bank, or I just use my wallet and I tell some piece of software, look, connect to the bank, let the bank know that I fit all the requirements they need without giving them all my pertinent information. And we'll talk about how we're going to do that. So that's number one. Number two is my credit report. The credit report is done by three companies right now, Equifax, Experian, and TransUnion, and it is a little arcane as to how they do credit reporting. It doesn't always make sense. There are ways to kind of gamify the system. Are there better ways to determine if I'm a good credit risk? And there probably are. So we're going to talk a little bit about that going forward. We are going to talk about an actual bank. Do I need to get a loan from a bank? Why does it have to be a person that decides, or multiple people, or an institution like that decides if I'm credit worthy and if I'm going to buy that bank? Why can't it be code? Why can't I go get a loan from some piece of code that evaluates my ability to pay it back and put certain parameters in there? So we can talk about what that's going to look like. Now, we want to go to the appraisal and the value of the house. This is something that obviously there likely needs to be someone that does an appraisal, and the reason is because you can't just look at a home's address and you can't just look at what pictures of it look like on the outside and determine the value of the home. Someone probably has to go inside and make sure things are kept up, make sure the roof is fine and the appliances are good and all that, because that is going to determine somewhat of the price of the house. But this appraisal is something that can eventually be an oracle, something that goes on chain and kind of travels with the home. So we're going to look at that a little bit. Title insurance. This is something that once homes are denoted on chain, once the ownership record of homes are denoted on chain, there should be no more need for title insurance. The blockchain technology should completely do away with the need for title insurance. This is something else we're going to talk about, the fact that the county keeps a database of who owns homes, who owns properties in these deeds, and the fact that this actually functions a little, the county database functions a little like a blockchain. And so are we going to need this physical record, or in some cases digital record, that is kept with the county of the deed, or are there better ways to keep track of who owns what? And lastly, we're going to talk about homeowners insurance or other forms of insurance and how that might or might not be upended with Web3, crypto, decentralized finance technology. So there are all these places we can go to talk about where Web3 might fit in, and hopefully do so in a way that doesn't seem gimmicky or kitschy or someplace we're trying to force crypto in, but show where it actually makes sense from an efficiency standpoint. So we had to go back here, talk about how a mortgage actually works, so that we can move forward and talk about where we might see crypto, DeFi, Web3 filling some of these gaps and making this process a lot more efficient. Thanks for watching this one. Please subscribe. Please visit us, interaccess.io, and we will see you in the next video.